Now, if you boil down trading, it can actually be quite simple. It's just simply buy or sell. But as we know, there's a lot more details that go into it, and usually people fall to market structure to be the way that they decide if the market is going to be bullish or bearish for the day. Market structure is here. It's an important foundation, but there's so many things on top of market structure that you need to be doing to understand daily directional bias. And that all starts with understanding the daily cycle. The daily cycle variations that exist, and noticing that price going from A to B, yes, the overall trajectory price went up, but think deeper to that. Price can go from A to B in many variations, and that's when you start to understand daily cycle variations or roadmaps of the day and how inducement and time come into the picture, where you can have the same outcome on 10 different scenarios. Price went from A to B, but all 10 scenarios will be completely different based on the major inducements, medium inducements, minor inducements, the time windows that price was reflecting, and the interactions with Asia range, previous day high, session high and session low. All of these things come into effect. And in fact, in previous videos, we have started to uncover this, the daily cycle variations that exist, the Asia range cycles that exist, the purpose of Asia range beyond just Asia high and Asia low liquidity. And we've done a lot of foundationary work on predecessors to a daily cycle. But in today's lecture, I want to break down to you the pivotal point of any daily cycle, which is going to be the inducement of the day. The inducement of the day sets the foundation for the roadmap of the day. In fact, if you've seen my public signals of 16 months of documenting my trades live ahead of time, 70 plus signals called out, 55% gain documented, that whole project that I've done, you'll realize every single one of my trades was interacting with the inducement of the day. Without the inducement of the day, you are simply trading blind because you have not understood the fuel of the market. The movements of the market are around market structure. They are around points of interest. They are around support and resistance levels, yes. But what is fueling that movement? What is the reason price goes towards that POI and then leaves that POI? It's always going to be inducement. And therefore, if you can accurately understand where the inducement is going to be, once it has happened, confirmed it's already happened, you know exactly how to trade, because it leaves just two models. You either do a continuation model or a reversal model. And what that looks like simply is if you have an inducement up here, that price is going to do an inducement high, then you have an opportunity to buy up into the supply zone. That becomes a continuation model. And then once the inducement has happened, you expect a reversal, and that becomes the reversal model. Hence the two trade models of the day you can have. And that's what we're going to be breaking down in this video: a continuation and reversal model, how to identify them, and then a case study showing real-time trades that I've taken in recent price action based around continuation and reversal models. So if I quickly show you this diagram, I cannot show you all of it because it's for the members of the Profit Paradigm Shift events we recently had. But you start to understand that the roadmap of the day, you have specific markers or anchors in the day. For example, you have the Asia range, and that's going to be Asia high, Asia low, and what happened inside of Asia. That's your first marker. Then you have your Frankfurt Open. Frankfurt Open serves a specific purpose. Usually it's going to be an early trap for early buyers and sellers, therefore sets the precedent for the first inducement of the day. And then after that, usually in the London key window, you will have the inducement of the day or the significant inducement of the session. That's usually in that key window. So then you have your London continuation or reversal play. And then after that, your next marker is going to be New York Open. That's similar to Frankfurt Open, is going to be a trap for early participants. And then the New York key window is where you'll see another inducement. And that can either be the inducement of the day, a continuation inducement, or a reversal inducement. Therefore, another trading opportunity. And then the last marker is going to be London close. And that's usually when the volatility starts to dry up. And that's when you start to look to end your daily cycle in terms of taking trades or looking to wrap up positions taken in London or New York window, because you might get a reversal or consolidation before the next day's cycle. So with those things in mind, there's obviously the trifecta where you have time inducement and lower time frame confirmation. I won't reveal this all now, but you start to see that once you've identified the time markers, those are the anchors or pillars of the day to support the daily cycle. Then you start to have your London and New York key window. These are going to have associated models with it, where you're going to have a London reversal model or a London continuation model. And with that, you have certain protocols in place, and that's going to be interacting with inducements. So if you have a point of interest or don't have a point of interest, and then you see if you have runs of liquidity or not, and then the types of inducements, major, medium, minor. So this is all going to be interacting with reversal or continuation models, and all these things tie together as well with the lower time frame confirmations and so forth. Okay, so let's say you have your Asia range, and then Frankfurt is going to be inviting early participants. So that could be, for example, you see a bearish trend, therefore inviting in people to be selling for the Frankfurt session, early sellers liquidity. And because we know we haven't had the inducement of the day, and we know that a liquidity pool resides above, and let's say you have a supply zone above, you can start to see that because we haven't had the inducement of the day or the inducement of the session or anything meaningful, we know liquidity is resting where? Liquidity is resting on this trend line, liquidity is resting on Asia high, and then we have a target of a point of interest for price to target. And then we have a target of the supply zone that can be the destination for price and also do an inducement. So we know that if we have overall a complex pullback, a bullish internal price action leading to the supply zone, so we have lower low, lower high being formed and a new lower low to be made, that's simple market structure. And we know that this supply zone could be the one originating that move. So then we start to see that price could do a reversal in London, We could have a reversal model in London after this point of interest, and this could all have lower time frame confirmations, supply zone mitigated, and maybe even lower time frame confirmations to get in. So we know the tradable portion can be trading it up. And we can trade up, and this can actually be the inducement of the day. So this inflection point now became the inducement. Let's say price played out like this. Then you had life before the inducement and life after the inducement. So what usually is going to be is this internal trend of higher highs and higher lows. This is the temporary internal trend going towards that supply zone. So you have a continuation of the temporary trend. And then once the supply zone is hit, once you've had the inducement of that Asia high, inducement of that trend line, and then whatever could be on the left, then you have the reversal model, which is in a POI after liquidity is taken, after the inducement of the day has been found, then price reverses from there and the new trend continues. This therefore leaves two tradable opportunities, and this zone becomes that inflection zone, the inducement of the day. And then you have the continuation model, which is buying up to the inducement. And then you have the preferred one, the confirmed one, which is the inducement related reversal model. And again, the trifecta we always speak about is always going to be in play: time, lower time frame confirmation, and inducement. So in this case, you can't just randomly buy up. You have to see confirmation over here, maybe a minor inducement, maybe a trap being built to anticipate an inducement happening. And then you need lower time frame confirmation and time. So lower time frame confirmation, for example, a break of structure model, and then time, for example, in the London key window or the Frankfurt trap. This is a great opportunity. And then the next one, after the inducement has happened, now you're expecting a reversal. You have point of interest. You know the requirements to refine a point of interest. I've spoken about it many times. Once you've confirmed the point of interest, once you've confirmed the inducement, then you need to find a time window. So for example, London key window, and then once again, lower time frame confirmation and a break of structure to confirm the entry. And then you have two potential opportunities. Usually they won't be in the same day, but you can see the move can be broken down into the pre-inducement and then the post-inducement, and you have tradable opportunities as a continuation of trend and a reversal of trend. Now, when you get to the New York window, the same thing can apply, where you can have multiple scenarios over here. For example, the New York Open, that can also be a trap. So you can start to see buyers movement over here. That's going to invite buyers liquidity in, and then you get a New York window continuation, a continuation of this bearish trend, and therefore you get a continuation model, and that can be inducing something on the left, inducing the liquidity of the New York trap, time window of the New York window, and lower time frame confirmation model. This would be how you'd look to navigate that. Another example could be, let's say price has induced Asia low and it's come to this intermediary demand area. This is now an intermediary demand area or a weak demand area. Why? Because the higher time frame supply has been met. So this complex pullback trend is complete and you're not expecting a bullish reaction, but you still might get a New York reversal where you get price going bullish over here because you had a sweep of Asia low liquidity, a sweep of London low liquidity, and then a demand area met, key time window presenting, where you can start to see we've had the variations of a London continuation, a London reversal, a New York reversal, or the model we spoke about, a New York continuation. So these are the various roadmaps. How are they anchored? Through time, through inducement, through lower time frame confirmation, and also understanding the foundations of what the roadmaps look like. So at a trading day or a trading session, all you need to understand is, where am I sitting right now? Where are the liquidity pools? Where is the inducement of the session? And can I trade into it or do I trade after it? And then once you've understood that, then you know exactly, am I trading a continuation session or a reversal session? And you know how to position yourself irrespective of market structure. So if we remind ourselves over here, we can have POI or non-POI based, and then the validations that are required around that. And your job is simply to understand, where's the inducements? Am I in London or New York window? Am I reversal or continuation? Then you use your lower time frame models and your time windows to know exactly when to execute and how to execute. So if you remember one of the previous videos, we did a market structure guide, a little bit more advanced, but we spoke about external ranges and internal ranges. Go check that video if you didn't already. But if we do a bit of a top-down analysis, we can basically see the same thing happening, where we have our external range. This is the main push from lower high to lower low. This sets the foundation of a external range where we have that low, a new lower low that would expect, and then the break of structure point is going to be when a new higher high is made. That is our external range, and therefore we know we are kind of in the middle of that range. We are not at a decisional, which would be over here. We are not at an extreme, which would be over here. So right now all we have is this internal bullish price action, which means we have a complex pullback. Internal higher low, internal higher high, internal higher low, internal higher high. So we are basically trending bullish until we arrive to a decisional or extreme. That could be the decisional, that is the extreme, and therefore we know that that new range, that new lower low is going to be made off premium supply levels. So right now down here, we are not at a smart area because this is post BOS supply. It's a weak supply we're not going to consider. So we know the immediate trend is bullish basically on this complex pullback up. When we come into an intraday time frame, when we're looking at the M15, same thing applies. We need to understand our points of interest and trend. We know this is a weak supply. We anticipate it to be taken out. And then we have all of this trend line liquidity that price can start to attack. We're understanding that the main push right now internally is bullish. What is the dealing range or trading range of this? The internal ranges, this low over here and this high over here. We found a main push from this higher low to this higher high. This arrow basically says the main push of intraday, and that main push of intraday has its external ranges of this high and this low over here. So inside of this range, all price action is temporary, and we know overall we want to go bullish to replicate this move. We've had an internal higher low to higher high, and then at some point we want a new higher high, whether that's going to be from the extreme making a higher high or whether that's going to be from the decisional making a higher high. How do we identify decisional or extreme? Well, same as always, it's the higher low to higher high origination point that becomes an extreme. We can see we had a nice inducement in here also, where we took a little bit of liquidity here before the volatility kicked in. And if we come and take a closer look on M5, this is where details matter. Where is the decisional? So we can say that this is the supply zone previous. Obviously, we have all of this trend line liquidity that price is targeting. A lot of liquidity to grab after this inducement. This inducement low targeted all of this previous supply liquidity. Now, what is the structurally relevant supply? It's the extreme, yes, because this led to a lower low, broke structure over here. So this lower low led to a lower high, more than 50% retracement, good duration in retracement and good depth, and an inducement inside of it. So a very valid point of interest that leads to a new lower low. So this became the previous supply level. This previous supply level had a reaction and then had a push out. This is the footprints we see of a type of point of interest, a decisional type known as a supply to demand decisional with a specific criteria. And it's improved. Why? Because it had a nice retracement, it had a nice duration of retracement, and it had an inducement within. So it meets the criteria we need for a decisional, and obviously leads to a new break of structure, a new higher high formed. So we know all of this is great price action. And then once price arrives to our weak supply, the new higher high is made. What happens next? Then we need to see how we arrive to our trading day, where yes, we are having this bearish price action arriving to our decisional or extreme that we've marked out. We know both of them are valid because they had inducements and they were structurally relevant. So everything of the pre-work is done. Now immediate price action we know is going to be bearish until our point of interest, bearish until demand. More importantly, we see inducements happening. Build up, inducement, mitigation. That's a liquidity cycle. We have over here a minor inducement, liquidity cycle. We have build up, inducement, liquidity cycle, mitigating previous on the left. Wonderful stuff once again. And then we have obviously liquidity pools to target, trend lines to target. So everything is adding up as we would want to see. And we just need to see how now the daily cycle is going to present. That's when we introduce our custom indicator I coded to map out the daily cycles, where we have all of the markers I mentioned, where we have the Asia range, Asia high, Asia low, beginning and end, Frankfurt open, and London key window. Then we have the same for the New York open, New York key window, and London close. So all the markers you need, time relevance, a lot of things I've added in, for example, previous day high, previous day low. If you want to see the session pip count to know the average daily range, average session range, for example, Asia on average was 20 pips, 30 pips. So you can do things with this information. And what we can start to see here is we have our Asia range build up right above our demand area. So this is going to be something important for me. This is where I'm going to dump into M1 now to dissect price action like a surgeon. We need to understand exactly who's in control and where the control is. So when we start to see our Asia range read, we see, okay, build up of liquidity, inducement, mitigation, bearish push. Who's in control? Sellers. Then price comes to that previous supply level. It doesn't induce anything. It respects it and gives a bearish reaction. Bearish breaks of structure. What is that telling me? Sellers are still in control, but no inducement. This means they are not heavily in control. They are passively in control. What happens over here? We get a small minor inducement and mitigation of the left. This means control, especially when you see the bearish reaction after that. So when price comes to this area over here, this area that we can see as equal lows. Who loves that? Smart money traders love to see that equal low liquidity. Then we see a run of liquidity. And then what do we see after the run of liquidity? Internal higher highs and higher lows, higher highs, higher lows. What does that mean? Buyers are getting interested. And where are they getting interested? On this potential trend line, because they've seen a run of liquidity candle, a smart money candle, and a trend line, and internal bullish price action, and maybe even equal highs to targets. Smart money traders are loading up on Frankfurt session, where on this trend line, they see a bit of a reaction. They see this local demand. They see bullish reactions, and they're loading up on Frankfurt open. That for us, we know is a liquidity target, because we saw sellers cycle, sellers control based on the inducement cycle that we see, sellers mitigation, minor inducement over here. So we target this liquidity over here. Then we arrive where? Bang on Frankfurt open on the minute. I told you time is essential. Time to see traps. I told you Frankfurt open is a trap. Many videos have mentioned this. When does the trap happen? On the minute of Frankfurt open, we come to a fake smart money zone, a fake demand. We get smart money traders reacting, a few bullish candles, a lot of bullish momentum, imbalances. Smart money traders are reacting and getting in. What happens right away? they get taken out, they get induced out. So we've had already manipulations happening for the day. So when we're leading up to this price action, when we know that this is all a trap, we're seeing this bullish price action, and we know the sellers are in control based on what we saw earlier, then we know that we have a continuation. We are going to be continuing bearish until we see the inducement of the day, but we had no opportunity to get in. Price didn't come to our preferred areas, decisional or extreme. We didn't have an inducement. We didn't have lower time frame confirmation. So it was non-tradable, but we knew the direction makes sense. It's going to be bearish. Once price is coming into our demand area now, and it's arriving to our London window, this is where we can start to get interested for the post-inducement reversal model, because we're going to reverse on all of this price action, all of this liquidity that we found of Asia high, this local trend line that we're finding now, this immediate trend line that we're finding, previous trend lines we've drawn. We know that liquidity is resting above, price has arrived to a demand area, and we are doing an inducement of smart money traders, Asia low, structural areas, this liquidity. If I show you on the left, this structure point over here that certain traders might be interested in looking at as we arrive to our refined area, which was our supply to demand decisional. Now we need to see, we've got a point of interest, we've got an inducement, we've got time window. We just need a lower time frame confirmation to trade this reversal model to target all of the liquidity we see. The liquidity of this overall trend line, the liquidity of this supply zone, this liquidity of Asia high, and targeting overall trend that we established at the beginning. We want to go back to complete the internal range, which is bullish price action. We need to target a higher low, higher high, higher low, higher high, demand area, reversal model with inducement, time, and lower time frame confirmation. That is how we navigate the markets. Inducement-based structure. And what does that look like? Well, over here, after the inducement first happened, we can't take a buy because price came into supply immediately and not in our time window. Over here, when price is now tapping into this demand area in our key window, we see a bullish reaction. We have a bit of an inducement of the previous low. So we can start to see, why not buy over here on this internal break of structure? When we see an internal break of structure over here, an internal higher high, internal higher low, why are we not looking to buy? Because the efficiency of the pullback. Price came to supply, so we could know lower low, lower high, lower low. We can't buy yet because we're not confirmed. But over here now, when we have the internal break of structure in our time window, because the previous lower high that made a lower low, that induced this stuff on the left, that induced this stuff on the left, that is well within our demand area. And most importantly, after the break of structure, we have not met the supply zone. We have not had the efficiency of the pullback, and therefore we know price can continue higher. And worst case scenario is price goes to our supply zone and then continues lower. Best case scenario, it does everything we wanted to, targeting all the liquidity, and we found a reversal model for the day. And that's exactly how you enter. You have found your refined IFC that led to the break of structure that had an inducement within it in our time window. Everything met over here. Entry, stop loss. Our stop loss just needs to be at this low in the bottom of our tolerable range of 3 to 7 pips stop loss size, and therefore you have your 1 to 3, 1 to 10 targets. Break even points being right here on M1 shift. Your 1 to 3 target being at the worst case scenario, price comes to the supply area and then continues the bearish trend. Best case scenario, you target your 1 to 10 after taking all of the liquidity you needed to take. So the trade is all set and locked and loaded. And then when we start to press play, that's what you need. Strong reactions after an inducement, right after a liquidity cycle, build up of liquidity, inducement of liquidity, reaction, refined IFC mitigation, continuation. Price comes to the previous supply level, gives a bit of a bearish reaction. That's expected. What do we see next? Price breaks through it. Now we've seen price inducing the area on the left. We're starting to induce this trend line. We've taken our partial 1 to 3, but now we're inducing this wick. We're inducing this trend line. Price might start to see bearish control. So what do we need to see? We need to see buyers confirm control. What does that look like? We need to see inducement and follow through. So this can be quite pivotal because this could be the inducement and then this could be the follow through. But this could also be the inducement on this area, and this could be the follow through. So we haven't established control until the internal range is broken between inducements. That inducement is the range high, that inducement is the range low, and until we break either one of them, we don't know who's in control. Once we see the break is bullish. That means this was not a bearish inducement of control. That was not the inducement. That structural wick was not irrelevant. The inducement of control was essentially this wick low of this minor inducement that led to this push out. What is this telling me? My inducement of the day, that first domino, is leading to further dominoes as we speak about it. The inducement of the day leads to more and more inducements. So this is a demand-based, POI-based medium inducement because we took Asia low and we took a smart money trap. And then minor inducements to follow through, the follow domino effects to confirm who's in control. So we know that we have target 1 met, all this liquidity above to take, and inducements showing me the buyers are remaining in control. So this reversal model is well on its way. And there we go. Price comes to the next supply level as anticipated. We already marked it out because it was an inducement supply. We induced a little bit higher than previous zones to invite in sellers, invite in that liquidity. But because it's not time-based, because it's not inducement-based, because it's not immediate trend-based, we are not trading it because it's not a reversal or continuation model. And then we continue to take that supply zone out and then go towards our 1 to 10 target. Perfect execution. And that leads to a perfect daily cycle based, POI based, demand based, structure based, but reversal model based on the inducement and daily cycle, and executed perfectly 1 to 10 in the session, meeting every single requirement that we have. And more importantly, when you follow the laws once again, where did price reverse to? The previous inducement demand. When did this reversal, temporary reversal, happen? In the New York window. When did it happen? After a buildup of liquidity, after an inducement of liquidity, after a structural shift, but no lower time frame confirmations for us to enter this reversal model. So we couldn't enter upon that temporary movement, but then price continued on by coming to a previous demand area, a previous inducement demand, and then tapping in basically to the pip and then continuing higher, continuing that immediate trend we expected, which was bullish because we were expecting an external range to be taken out, and that's when it was taken out. So structure was complete, POI is complete, lower time frame confirmation complete, inducements complete, time windows complete, everything is there. This is the laws of price action. There is no accidents in this stuff. And then what happens over here is this leads to a perfect smart money trap, by the way, because smart money traders not understanding how daily cycles work will be seeing this build up of liquidity, inducement, and not understanding control will be selling in this zone, understanding that London close can also be a trap, just like the other trap moments of the day. Now, if you want me to break down a continuation model, let me know. I'll make another video on it because there's not enough time for this video, but at least you got to see an element of how the daily cycles are working and a reversal model in action. And something that I always say, my last piece of advice that will always be there, a restricted trader is a profitable trader.